From the pandemic hangover to global conflicts, it seems like we're walking on financial eggshells. In this video, we're diving into 15 financial facts that are, to put it lightly, a little unsettling. Let's get into it. When Wall Street starts openly warning about a recession, it's time to pay attention. The signals are clear and the stakes are high. Rising interest rates, the Fed pumping the brakes on its bond-buying spree, and a whole lot of uncertainty. These are not just numbers, they represent real challenges for businesses and individuals alike. The big question on everyone's mind is, how bad could it get? Well, that's what we're going to explore. From potential job losses to shrinking investment portfolios, the impact could be widespread. Knowledge is power. The more you understand about the potential risks, the better prepared you'll be. We'll dive into the data, the trends, and the expert opinions to give you a comprehensive view. We're talking about potential market crashes, economic slowdowns, and a whole lot of volatility. These scenarios can be daunting, but they are not insurmountable. But don't worry, we're going to break it all down in plain English and talk about what you can do to protect yourself. From diversifying your investments to building an emergency fund, we'll cover practical steps you can take. Deutsche Bank recently made headlines with a bold prediction, a 20% crash in the S&P 500. They cite persistent inflation, aggressive interest rate hikes by the Federal Reserve, and ongoing geopolitical uncertainty. A 20% drop would officially put us in bear market territory, significantly impacting investors and the overall economy. It's important to remember that this is just a prediction, but it's definitely something worth paying attention to. The stock market has shown some signs of life lately, with prices rising and traders becoming more active. But according to Morgan Stanley, this could be a classic bear market rally, a temporary upswing in a broader downward trend that often misleads investors. They believe that once this temporary optimism fades, the market will resume its downward trajectory, continuing the overall bearish trend. Bear market rallies can be incredibly deceptive, luring investors into a false sense of security and making them believe that the worst is over. Even seasoned investors can struggle to differentiate between a genuine market recovery and a bear market rally, often leading to costly mistakes. Paying close attention to economic indicators, corporate earnings, and market sentiment can provide valuable clues. These factors can help investors make more informed decisions and avoid the pitfalls of a bear market rally. Goldman Sachs has issued a sobering economic outlook. They've significantly lowered their GDP forecast and raised their probability of a recession. High inflation, rising interest rates, and slowing consumer spending will likely push the economy into a downturn. The Fed's aggressive interest rate hikes, while necessary to combat inflation, will inevitably slow economic growth. The risks of a recession are increasing, and we should be prepared for a potentially bumpy economic ride. Bank of America's chief investment strategist, Michael Hartnett, warns of worsening inflation and a recession shock. Persistent inflation, rising interest rates, and geopolitical tensions will create a perfect storm. Hartnett's warning is particularly concerning because he's known for his accurate market calls in the past. We're entering a period of significant economic and social upheaval. The U.S. Treasury bond market has been flashing warning signs. The yield on the 10-year Treasury note has surged, reflecting growing concerns about inflation. Investors are demanding higher yields to compensate for the eroding purchasing power of their investments. Historically, sharp spikes in bond yields have often preceded economic recessions. While this correlation doesn't guarantee a recession, it's a pattern that investors and economists are watching closely. The bond market is essentially sending a signal that it's worried about the future. David Stockman, a former Reagan administration official, warns of a stock market crash of biblical proportions. He believes the Fed's easy money policies have created a massive bubble that's about to burst. Stockman argues that the Fed's actions have created a dangerous financial imbalance. When the bond bubble bursts, it will trigger a domino effect through the entire financial system. William Dudley, former president of the New York Fed, warns about the Federal Reserve's impact on investors. Dudley argues that the Fed has no choice but to raise interest rates aggressively to combat inflation. These rate hikes will inevitably slow the economy and likely lead to a decline in asset prices. The era of the Fed put, where the central bank would always step in to save the market, may be coming to an end. John Hussman, president of the Hussman Funds, believes we're entering a period of dismal stock market returns. He argues that the market is experiencing one of the most extreme valuations in history. This overvaluation will inevitably revert to the mean, leading to years of negative or below-average returns. Investors should brace for a prolonged period of poor performance in the stock market. Harry Dent, a renowned economic forecaster, predicts a massive global stock market crash. Dent's prediction is based on his demographic research, suggesting a period of slowing growth and declining consumer spending. He argues that this demographic shift will create a deflationary environment, leading to a collapse in asset prices. Dent believes the crash will begin in Japan and spread rapidly to other major economies. Investors should prepare accordingly. The Russia-Ukraine conflict has sent shockwaves through the global economy. Some of Wall Street's most influential investors are deeply concerned about its long-term consequences. They fear the conflict could escalate, leading to a wider geopolitical conflagration and a deep global recession. These investors are reducing their exposure to risk assets and increasing their cash positions. They're also investing in safe havens like gold and U.S. Treasury bonds. Their actions speak louder than words. The tech sector has been hit hard as investors have become increasingly risk-averse. High-growth, high-valuation tech companies have seen their stock prices plummet. Rising interest rates, slowing economic growth, and geopolitical instability have driven this shift in sentiment. The era of easy money and sky-high valuations appears to be over. Investors are now demanding profitability and a clear path to growth. A Robinhood stock collapse serves as a stark reminder of the risks associated with investing in volatile markets. The company's stock is down over 80% from its all-time high. Robinhood's struggles highlight the importance of a long-term investment strategy. The company's rapid rise and fall is a cautionary tale for retail investors. Wealthy investors have been quietly positioning themselves for a potential crash for months. They've been reducing their exposure to stocks, increasing their cash holdings, and investing in safe havens. The surge in short positions taken by hedge funds is a clear indication of their concerns. In addition to short selling, wealthy investors have been piling into defensive assets like gold and U.S. Treasury bonds. These assets tend to hold their value relatively well during market downturns. The actions of these wealthy investors speak volumes. China, the world's second-largest economy, is facing a growing number of financial and economic challenges that are becoming increasingly difficult to manage. The country is grappling with a slowing economy, a property market bubble, and renewed COVID-19 outbreaks, which have severely impacted daily life and business operations. The Evergrande crisis exposed the fragility of China's massive property sector, highlighting the risks of over-leveraging and poor regulatory oversight. China's strict zero-COVID policy has led to rolling lockdowns, disrupting supply chains, and slowing economic growth, causing widespread economic strain. These lockdowns have also fueled social unrest and raised concerns about the long-term impact on consumer spending and business investment as people grow increasingly frustrated. China's economic slowdown has significant implications for the global economy, affecting trade, investment, and financial markets worldwide. We've covered a lot of ground in this video, and I know it can feel overwhelming. But remember, knowledge is power. Understanding the potential risks and challenges ahead is the first step towards navigating them effectively. The key takeaway here isn't to panic, but to stay informed. I'd love to hear your thoughts. What are your biggest financial concerns right now? Let's discuss in the comments below. Until next time, stay informed and stay invested.